Joining me now to unpack all this and more, including a look at the latest tax and policy changes, is Fidelity Vice President of Tax and Retirement Research, Peter Bowen, and Fidelity Director of Tax and Retirement Research, Michelle Munro. Michelle, Peter, welcome.
Great to
have
be
you
here. Thank you, Glenn.
Yeah, thanks, Glenn.
Well, Peter, let's start on the capital gains inclusion rate. So last year's budget proposed some changes, and now that's been pushed to January 1st, 2026. Let us know what happened and what we have to look forward to.
Lots of turmoil, right? Lots of change. So just to step back a little bit, the proposal is to increase the capital gains inclusion rate from 50% to 2/3. It was supposed to be effective as of June 25 last year. And we should bear in mind that individuals have a $250,000 per year buffer, so gains up to that are still at the 50% inclusion rate. Above that is where the 2/3 applies. Yeah. So it doesn't affect very many individuals, still a significant number of people, of course. Mm-hmm. Corporations and trusts don't get that buffer. At the end of January, the government came out and said, hey, postponing this to, as you noted, January 1st, 2026. Now, that was at the end of January, better late than never, perhaps, but creates a lot of noise, a lot of turmoil, a lot of challenges too. So I was thinking they might come out and defer it to January 1st of this year. Mm-hmm. As I think about it, it's probably good that they did it till January 1st of next year, because people are still making decisions. There are transactions going on as we speak, and now we have certainty until the end of this year. As well, the big question is, will this get passed into law? Right? The Conservatives have said they will reverse it. And even some of the candidates for the Liberal leadership have effectively been reported as disavowing this. So we will have to wait and see, but at least we have certainty through till the end of this year.
Were you surprised that CRA came out and said, well, it's not passed, but we're still going to hold you to it for 2024's tax year?
No, because that's the way they operate. That's consistent with years past.
Err on the side of caution.
That's their approach, because what if it does get passed into law and they weren't enforcing it, then you've got an even worse mess. Either way is a problem.
But we don't have to worry about it now.
But we don't have to worry about it.
Okay.
Thankfully.
Michelle, what about taxpayers who made dispositions prior to that date in June last year and then found out that this is all being pushed to January of 2026?
So we had the announcement in the 2024 budget, which was April 2024, and it was a 10-week rollout coming to effect in June 25th, 2024. So taxpayers were doing their planning ahead of time, as one would. So there was taxpayers who triggered the capital gains prior to that June 25th date to take advantage of that 1/2 inclusion rate. So a couple instances where we saw that really was when private corporations who had unrealized capital gains knew that they were going to be rebalancing, possibly paying money out, wanted to trigger those gains prior to that date. Some other examples, and we heard this a few times, people who were selling properties like cottages and what have you, that they were looking to sell them post that date. Mm-hmm. Well, they moved it up, sometimes even taking a haircut, a lower proceeds price, to get the lower inclusion rate. So the question we keep getting asked is, well, what happens to these taxpayers? Well, it's unclear, but I'd be highly surprised if there was any sort of relief for them. And I think what the messaging here is, you do the best tax planning that you can with the information that's available. I don't think the situation, I've never seen this in my career.
Because it was in limbo, truly. And decisions were made while that legislation was in limbo. Peter, what else is in limbo right now?
There are actually a slew of provisions that have yet to be passed into law. The increase in the lifetime capital gains exemption, right, is proposed to go up to $1.25 million. The effective date on that was supposed to be, and continues to be, June 25 last year. So we actually know that's tied to the capital gains inclusion rate, but nonetheless, they are leaving with that same effective date. Now that's a good news thing for people who are doing transactions. So that actually makes sense. I would think even if the government changes, they would stick with that. We've also got the Canada Entrepreneur Incentive. Not the best name because it doesn't roll off the tongue to me. Highly complex tax provision, similar to, but more complicated than the lifetime capital gains exemption. So that's in limbo. There are some changes to stock option rules. And not a budget 2024 item, but an August announcement related to bear trusts. So, a year ago, investors were going through turmoil, trying to trying to figure out, did they need to do certain tax filings? And lots of them did do these tax filings. I think it was the second last business day before those filings were due. CRA just came out and said, oh, no, you don't have to do them. So they have been deferred, and in August, as I said, they've deferred them further. It's the first effective date will be for years ended December 31st, 2025, meaning next March is when this becomes an issue. And perhaps more importantly, there have been an expansion of the exemptions. So a lot of the situations that advisors, clients were dealing with no longer have to have those filings. So more to come on that. I would hope those changes would get passed into law regardless of who's in government, but again, there's that element of uncertainty.
I'll go back to the intro today. There's lots unknown out there. If it's tariffs, if it's taxes, you name it. And just to our viewers, if you have any questions, please do send them through, and I'll get them on this monitor right here. Now, Michelle, why don't we talk about the 2025 budget? What does all this mean potentially for the budget?
Lots of unknowns, as you say, Glenn. Well, Parliament is being prorogued until March 24th. At which point we'll have a new Liberal leader. They could announce a federal budget at that point. It could be quick, it could be long. I've heard it reported that other leaders have been canvassing for budget ideas, which to me makes me think that, well, there's some work being done behind the scenes. Like, what will that budget, if and when, there's work being done behind the scenes of what it will look like. I'm going to do a little shout out for Fidelity here, watching a Fidelity webcast. We always do, Peter Bowen holds the pen, a pre-budget submission on key things that impact really investors within the industry. And we try to put our 2 cents in worth as well.
Excellent. Peter, donations, what's going on with those?
Yes, speaking of in limbo, this is another provision that's technically in limbo. I don't think there's
So this whole topic
much doubt that it'll be passed, though. So
Lots to happen.
this was in response to the postal strike. So charities were unhappy that the mailers that they typically send out in November and December were not getting delivered to Canadians because of the postal strike. So the deadline for donations to be effective for the 2024 year end has been, as a one-time offer, extended to February 28th, which is actually different than the RRSP deadline, of course. But so that means people still have an opportunity for the next couple of weeks to make donations and have them count towards their 24 tax return. That said, couple surprises there. Firstly, payroll donations made through payroll don't count for this. So you could do it, bi-weekly credit card donations and they count, but not payroll donations.
Because it had to do with the Canada Post strike. What about physically mailing something?
Well, it's more the mailers from the charities that drove the extension and the date. So why they've said payroll donations don't count, I don't know. And more importantly, we do encourage advisors to think about in-kind donations because they are more tax efficient. So if you do a donation of an investment, an appreciated investment in kind, you don't have to pay the tax on the capital gain and you still get your donation receipt. Well, in-kind donations don't count towards last year for some reason. And again, could please explain to me why? I don't know.
I defer to you.
Why didn't they just say any donation made in January, February counts towards 2024?
Yeah.
That would have been simpler. In-kind donations, though, for whatever reason,
Is there
don't
likely
count.
to be an appeal? Would anybody put an appeal together that could change that? Or do you think that that is a done deal?
I think that's unlikely.
Done deal.
Unlikely.
Well, not a big game changer overall as far as this change in timing, but Michelle, tell us about what's going on at the Canada Pension Plan.
So Canada Pension Plan, there has been an expansion of CPP contributions. We're in the final year of a 7-year expansion. So what does that mean? Well, you make CPP annual contributions. 2024, it was just over $4,000, which an individual would make. In 2025, it was going to just over $4,400, so an increase of 9% a little bit, which is not insignificant. It's fairly, and part of that is because of inflation. Another part of that is because of that CPP expansion. So we see the increased contributions as an employee, but self-employed individuals who pay the employee and the employer portion will feel that. A tighter pinch, as well as owner-managers of private corporations. Well, they're going to see an increased payroll tax, as well as when they're thinking about, well, at the end of the year, do you bonus out subject to increased CPP contributions, or do you pay a dividend to that shareholder? So these are the things that owner-managers, shareholders are thinking about with their accountants. As well as sometimes a financial advisor can help think this through as well. So at the end of the day, I talked about we have the CPP expansion. CPPs really, it was intended to replace a quarter of a basic worker's wage. So that's going up to 33% once it's fully implemented. But even somebody who says, retired more recently, Glenn, will see a little bit more to their CPP benefits as a retiree. But the real benefits are those who are really just starting their careers and are going to contribute for the next 40 years.
Thank you for that. Corporate class structure. As far
Shifting
as I
gears.
know, it's alive and well at Fidelity. Could you let us know what's happening with Fidelity's corporate class structure? Perhaps if you could preface the discussion with a bit of history as well, because it has been out for a long time. I think there's been some misunderstandings on the street as far as if they're still around and so on. It's doing very well at Fidelity, and just give our viewers an idea of the history and then where we're at today.
Well, I think the misunderstandings tend to come from companies that have shut down their corporate class structures.
Because that's been
Go
happening.
figure. But the corporate class structures have been around for a very long time. The oldest standing one, I think, was started in the 80s. Fidelity's was launched in, I think, 2000, so quarter century. And they continue to be very effective. And I think there's about a dozen corporate class structures in the industry, each of which has assets over $1 billion. I bet you can't guess which company has the largest.
I would think it's Fidelity.
It is indeed. So they are for highly taxed investors as a general rule. So high income individuals, any people receiving old age security and subject to the old age security clawback, and corporations. And so those are the target market for those products, because they bring it the potential for lower taxable distributions. And historically, this has worked very, very well. Long term, we think it will continue to work well. In any one year, if you compare it to the equivalent trust, all bets are off. There are a lot of timing differences. So in terms of an update, Glenn, we pay our capital gains dividends in January of each year. We did not have to pay one in January of 2025.
And why is that?
Things worked out very well. There's something called the capital gains refund mechanism that helps a lot when you have significant unrealized appreciation at the end of the fiscal year, which in our case is November. So that worked out very, very well for us. It did a year ago as well.
Good.
So we didn't pay capital gains dividends in 2024. We will not be paying capital gains dividends in 2025. We do encourage advisors to make sure their clients have an expectation of receiving them from time to time. I'd also note that although they're called capital gains dividends, they are treated as capital gains for all intents and purposes.
So plan for it, but if it's managed like it has been,
Good news.
there may be an alleviation of that risk.
So good news for last year and this year.
Right.
And in terms of last year, that means when the T5 slips come out,
Right.
there will be a zero in that capital gains dividend box for the Fidelity corporate class structure class funds. The Canadian dividends also get paid out from on an annual basis. That will happen in May. And the other thing that people need to be cognizant of with corporate class structures is that I think the reason why CRAs allowed them to exist is that there are trade-offs. And depending on how one manages one's corporate class structure, a corporate class structure can end up paying income taxes. Now the good news is Fidelity's corporate class structure has never had to write a check to CRA, and we're just finalizing our first cut at the estimate for this year, 2025, and it's looking good. We don't know for certain until later in the year, but we're quite optimistic that we will not have an income tax expense in our corporate class structure for the 2025 fiscal year.
Excellent. We have a question that's come in. Perhaps I'll send this to you, Michelle. When an investor passes away, what are the tax implications for their RSP, and what questions might they ask their accountant?
Okay, so let's roll back on death. On death, if there's a surviving spouse, many accounts and assets can roll on a tax-deferred basis to the surviving spouse. So they didn't specify in the question, but let's just assume for simplicity there's no surviving spouse.
Sure.
There's a deemed disposition and liquidation of assets, sort of like a capital gains tax, if you will. But for this specific question, they're asking about, well, what about an RRSP or a RIF? Well, it's deemed to be liquidated on death. So sometimes what happens is that an individual, they pass away, there's that liquidation of that RSP or that RIF, and they've done a great job of saving and investing during their lifetime, and all of a sudden they have a big tax hit into their RRSP. And all of a sudden, half of that or more is going to taxes. This is bringing out, thinking about where an advisor has potentially having a really powerful conversation with their clients to help them think about, how's your health? What's your life expectancy look like? You have a large RRSP, RIF balance. Maybe if it's a RIF, take out a little bit more than the RIF minimum, so it's taxed at a lower rate today. Max out that TFSA contribution, non-registered investments, corporate class, and overall saving taxes for the individual. And it's part of estate planning or legacy planning even.
Excellent.
And that goes to the value of long-term financial planning and tax planning, of course, and sort of brings us back to that first topic that we don't have certainty around the capital gains inclusion rate, because if someone's sitting on a sizable capital gain or capital gains across many investments, and if they were to pass away and have gains of more than $250,000 more than a year from now, is the capital gains inclusion rate going to be 50% or 2/3? Should we trigger some capital gains this year or not? I wouldn't rush into anything in that front because presumably we will have certainty on the capital gains inclusion rate sometime later this year, but it's still a bit of a question of that uncertainty that we've been put into.
It is.
Sorry, did you say uncertainty or more uncertainty?
More.
Michelle, let's recap limits for 2025 for RRSPs and TFSAs.
So RRSPs, the contribution limit is based on earned income of the prior year. The maximum for 2025 is $32,490. Now, there's carry forward room if someone wasn't able to make their maximum. So the importance of going back and looking on what's on the prior year notice of reassessment or of assessment, going to the My Account online CRA.
Has each year's increase been predictable? Is it a consistent percentage increase?
I think it varies with inflation.
Okay.
But
Makes
it goes up a little bit every year.
Okay.
Yeah. RSP contribution room is 60 days after year end, but falls on the weekend, so we have until March the 3rd. So we have an extra couple days there. TFSA contribution room 2025 is $7,000.
Which has been consistent, I think, for a couple of years.
Yeah. And somebody who's never contributed to a TFSA and say they were eligible since they were very first introduced in 2009, they could have the cumulative amount would be $102,000.
There was a period a few years ago where I believe the contribution limit for TFSA was 10,000.
I know.
It capped out, then went back down to
Then went
6 or
back.
so. Now it's at 7. Do either of you have insight from the government CRA? Just are they concerned about TFSAs being larger than expected, or helping just certain people, or is there any commentary you've picked up?
We haven't heard anything along that front. At some point, the loss of revenue to the government might become large enough that they say, okay, it's time to pull back a little bit here. But I have not heard anything from the government at all on this front. So
I was going to add to that, Peter. I think that there was an initiative by the CRA of looking at people who had really large balances inside their TFSA, and they were doing some audits,
An
if you will.
analysis, yeah.
An analysis, if you will, yeah. But there were people who were trading inside their TFSA. Effectively, their position was running a business through their TFSA.
I see.
But for your average Canadian, it's not an issue.
Good.
Yeah. Okay, so back to that. I wanted to highlight the importance of not over-contributing, and that. And as an advisor, you don't always know the full picture of what clients are doing. So ensuring that your client's not over-contributing, going back to the CRA, my account, looking at those balances. There have been some recent court cases specifically on the RRSP where somebody has over-contributed and they went back to the CRA and said, well, under fairness provisions, whatnot, I didn't inadvertent, et cetera. The courts have been quite harsh and said, nope, you over-contributed. The penalties are 1% per month of the amount of the over-contribution. It often takes a year or so or more for the CRA to investigate. So what happens is that 1% per month, then there's interest and penalties on top of that, and it becomes very punitive. So.
Makes sense. Peter, T-Series. Questions come in on the best way to use T-Series in 2025. But first, if you could define T-Series at Fidelity, and then talk about maybe what the investor's asking.
Well, although T-Series was launched by Fidelity, that was our innovation. It's widely available.
Your
across,
innovation.
Yeah, thank you.
Well.
Across the industry, and it is a tax deferral tool. So it is a cash flow tool to be used in situations where a taxable investor, generally again at moderate and higher tax rates, is sitting on a capital gain of an investment, wants some cash flow from that investment, so they switch from the regular series to the T-Series.
Which is not a disposition.
It's not, that's tax deferred,
Right.
Exactly, as long as you stay within the same fund. So when we talk about the best use of T-Series, the best use of T-Series is on an appreciated investment where you stay within that investment. Because if you move from one investment to another and turn on T-Series there, well, that will trigger your gain anyway. So you have to stay within the same investment fund that you built up that gain, and you have to think about different tax rates, which could be affected by the capital gains inclusion rate down the road. Again, I actually think that's unlikely, but nonetheless. So it is for those people who need cash flow and have a significant capital gain and are in a moderate to high tax bracket. They're the ones who really should be thinking about T-Series for the deferral. I will also add in a pitch for a charitable gifting strategy where one uses T-Series to draw down the adjusted cost base over time off of an investment. You can use that, like me, if I'm employed, I'm using this, in fact, I'm using that cash flow to buy another fund, bring down the ACB, and use that for charitable gifting purposes. It's actually the most tax efficient way to do charitable gifting.
Peter, I'm setting you up here, but I know some advisors say, oh, we don't want to use tax series because of the tax bomb, which is complicated by the increased capital gains inclusion rate. But what are your counter comments to that?
So the concern from some advisors and some investors is a fair one, that they are worried about that. We're deferring the taxes. Oh, my estate's going to have to pay that big tax bill. I don't want that
It's
situation.
inevitable.
And the answer sometimes will be, yes, you do want the estate to have that bigger tax bill because the after-tax amount will be higher than it otherwise would be because we've deferred taxes for the long term. You know, and we've done some math on this. We've got a deck on this we present on occasion, and you look at your expected rate of return, your time horizon, and then what's the marginal tax rate right now and in the future.
Right.
But if someone is using T-Series to defer taxes for 10 or 20 years and they're in a moderate or higher tax bracket, they are going to be better off because they've used T-Series.
And I just want to stress that because T-Series, it's a years, decades solution
It's
of
a
a
long-term
tax-efficient
plan.
cash flow.
It's a long-term plan.
Peter, the information that you referred to, the papers that you've both worked on, are they available online? If you just let everybody know how to access those documents.
They're not actually. Maybe we should do a paper on it, but we do have it in a deck that we've
That
presented.
you've talked about in presentations.
to advisors.
Okay.
Sure.
Well, stay tuned. Maybe it'll be after today available online. Thanks, Glenn.
Suddenly we're
more
going
work
to
to
be even
do.
more
Yeah.
busy.
Peter, what should we be thinking about going forward? What have you and Michelle got your eyes on?
Well, we've had a lot of change in the tax environment in the last year, 2, 3 years, and it's really bounced around as well, which is challenging. That's likely to continue. I think it should be the expectation. We've got a change in the leadership of the Liberal Party. We've got a throne speech coming up at the end of March. Perhaps we have a Liberal budget being presented to Parliament. We don't know. Will the government fall before that even happens? When will that budget be?
Yeah.
And even if, of course, if there's a change in government, you know, maybe we won't have a budget till the fall. I don't know, and we're just in that position of uncertainty. Although the one thing I think we do know is that there will be more change.
You used that uncertainty word again. You know, we are doing this webcast mid-February, and there's been a tax holiday for a month and a half or thereabouts. And, you know, on the topic of tax, it had to do with children's clothing, I understand, prepared foods, alcohol, and restaurant meals. Michelle, have you taken advantage of the tax holiday? Because it's finishing this week.
Best to eat out as much as
Okay, good.
possible. It's winterlicious here in Toronto, taking advantage of that tax holiday.
Peter, have you?
Off to the liquor store sometime this week, I think, to take advantage of that, because it applies to wine, which
That's right.
might as well take advantage of it. We have that sale till Saturday.
Well,
That's our last day.
Probably both inspired a lot of our viewers.
Watch the pennies and let the dollars take care of themselves.
And pennies may not exist any longer if we follow in the path of the United States. We should wrap.
They don't
I
exist.
appreciate all the information, although uncertain information that you've provided today. It just shows that what you've both got on your plate. I know our viewers appreciate it, and thank you both very much for being with us today.
Pleasure to be here, Glenn.
Thanks, Glenn.